Hey everyone, welcome back to Corporate Decoder, the place where we break down those confusing corporate filings into plain English to see what is really going on behind the scenes. Get ready because today we are diving into YHN Acquisition I Ltd's latest report, and it is all about a very important agreement being extended. This is truly a peek into the gears turning for a major business combination. And hey, before we jump in, make sure you are subscribed to the channel for more of these decoder sessions. Also, we have a fantastic community over on Discord, link in the description below, where we discuss these filings and more. Alright, so what we have here is a report from YHN Acquisition I Ltd. Think of them as a special purpose acquisition company, or SPAC. Their whole purpose is usually to merge with another company to take it public. So they are like a blank check company that finds a private company and helps it become a public one. The big news in this filing is that YHN and another company called Mingda Technology Limited have amended their business combination agreement. So they had an original agreement, and then they've made some changes. The most recent change we're looking at now is amendment number 2, which was signed on the 15th of December 2025. So what is this amendment really doing? It is pretty straightforward. It is extending the deadline for this business combination to happen. The original deadline was approaching, and now they've pushed it back to the 18th of June 2026. Think of this as getting more time to finalize the deal. Why do companies do this? Well, sometimes deals get complicated. They might need more time for legal approvals, regulatory steps, or just to make sure all the terms are ironed out perfectly. It is not necessarily bad news, but it does mean the merger isn't happening quite as soon as planned. This agreement involves YHN Acquisition I Ltd and Mingda Technology Limited. We're told that YHN is the parent company, and Mingda is the company they are looking to combine with. This whole process involves a few mergers and a reincorporation to make everything happen smoothly, so Mingda can become a publicly traded company on NASDAQ. This kind of deal often starts with a lot of excitement about the future potential of the combined company. They'll talk about synergies, growth opportunities, and how together they will be stronger. You'll see language about anticipated initial enterprise value benefits of the combination and expected future performance. Now, every deal like this comes with risks, and this report is very clear about them. One of the biggest risks is that this deal might not actually go through, or it could take longer than expected. If that happens, it can really hurt the stock price of YHN because investors were counting on this merger to happen. There is also the risk that the conditions needed to close the deal might not be met, including getting shareholder approval. Another critical point is whether the companies can actually achieve the benefits they are promising. It is easy to talk about synergies and growth, but actually making them happen is a different story. This is where the real work begins after the deal closes. Looking at some of the specific instruments involved here, we see references to ordinary shares and rights. These are the pieces of ownership and entitlements that shareholders hold. For example, YHN has units each made up of one ordinary share and one right that gives the holder a fraction of another ordinary share. This structure is common in SPA CAs. The fact that they are extending the closing date suggests that either some of these conditions are taking longer than anticipated, or perhaps there are negotiations related to the terms of the deal. Remember back in November, there was an amendment that changed how the earnout consideration was calculated from future revenue to post-closing share price performance. This is a significant shift and likely played a role in why more time might be needed to get everything in order. The ultimate goal here is to have the combined company trade on the NASDAQ stock market. This is where millions of investors will be able to buy and sell shares. The listing itself involves a lot of requirements and scrutiny. Now let's zoom out a bit and think about what this extension really means. On one hand, it shows that the parties are serious about getting this deal done and are willing to put in the effort to make it happen correctly. They are not rushing it. However, it also introduces a period of uncertainty. For investors in YHN or Mingda, this extension can be a bit nerve-wracking. They want to see progress and certainty. The extended timeline means that the shareholders of YHN will have to wait longer to vote on the proposed business combination. When we look at this filing, it is really about managing expectations and providing transparency to investors. The core of the business combination seems to be moving forward, but with a revised timeline. The key risk remains whether this deal will eventually close, and when the companies are clearly trying to balance the need for more time with the desire to maintain investor confidence. The fact that they've kept amending the agreement also tells us that the terms are still being fine-tuned, which is normal in these complex transactions. Overall, this report is a procedural update, but it is a crucial one. It signals that both YHN and Mingda are committed to the combination but are navigating a slightly longer path than initially planned. Investors will be watching very closely to see if they can meet the new June 2026 deadline, and more importantly, if the combined entity can deliver on its promised value. So here is my take on all of this. The extension of the outside closing date to June 2026 is a double-edged sword. On the positive side, it shows commitment and a desire to get the deal right, potentially avoiding future complications. It also suggests that the parties are still working through the details, which is common in these types of mergers where complex business structures and financial arrangements are involved. However, the flip side is that extended delays can create uncertainty and potentially lead to investor fatigue or a loss of momentum. A key risk here is not just the possibility of the deal falling apart entirely, but also that the market conditions could change significantly by June 2026, impacting the valuation or the strategic rationale for the merger. The fact that they previously adjusted how the earnout was calculated from revenue to share price performance indicates that the market sentiment and the perception of future performance were already important factors being negotiated. This current extension might be to allow for further adjustments or to ensure that all parties are comfortable with the revised financial realities and market outlook. My conclusion based on this filing is that the business combination is still alive, but it is certainly not a done deal yet. The companies are actively managing the process and trying to navigate the complexities. Investors should remain cautiously optimistic, but also mindful of the inherent risks associated with long drawn-out merger processes. The ultimate success will hinge on the ability to close the deal within the new time frame, and then for the combined entity to execute its strategy effectively and deliver on its growth promises. It's a waiting game for now. Alright, that is our deep dive into YHN Acquisition I Ltd's latest filing. What are your thoughts on this extended timeline for the business combination? Do you see it as a positive sign or a cause for concern? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more corporate decoder videos. And don't forget to join our Discord community linked in the description. It is a great place to connect and discuss these filings. Thanks for watching, and we'll see you in the next one.